Well, good weekend, all. Ira Epstein with your Spider ETF stock market wrap-up, and this is your weekend edition. I'm putting this out Saturday, December 10th, 2022. Now, let's talk about how you have to handle this week because it's tricky. You have an all-important CPI number coming out. On Wednesday, you get the Fed Open Market Committee. That comes out at 1. The Fed press conference begins at 1:30, finishes about 2:30 or so Chicago time, that's Central Time. It's going to be very difficult to trade this market as you get through these two events. As you get through the CPI, you can trade the rest of that day normal. You'll have an idea, hot number, weak numbers, the market going up, going down because of what you saw there. That's the tricky spot. There's not a lot of debate from what I'm seeing over the weekend for a 75 basis point hike, even with a fairly hot, I thought at least hot, PPI number. We'll see if the CPI changes that. I happen to be of the opinion, by myself it appears, that the Fed should stick with 75 basis points, stay strong. You can also lower in February. You can cut, you don't even have to go 50, you can go 25 if you think your numbers worked. But so far, the lag effect is a guess. Why not push it over the edge a little bit and you can cut, be it in the February number from, don't even go 50, go 25 if that's it. If you don't see the lag effect has worked, you open the door up for another 50, 75, whatever. For whatever reason, people seem to think, maybe wrong, that, that 5.25%, 5.5% range, that's going to be it. Why? If inflation stays overly sticky, you've got to be more aggressive. I don't know what sticky means yet. We're just getting our first reports, but the ones we saw last week, I wasn't satisfied that the unemployment claims are shooting up. I wasn't satisfied that the PPI numbers are showing a big decline. They're wobbling. They're not going the way in a big manner. Now, if the CPI number comes in, why would that, when it comes in on Tuesday, why is that going to be radically different? It could be, but I'm not seeing it. The headline CPI, I think we all know because of energy prices, should be down. I mean, look at your gasoline, look at heating oil, look at crude oil. You're pushing the $70 range, okay? In Chicago, I'm talking WTI numbers, not the Brent, which I consider the overseas numbers. But we'll see what goes on through that. So let's take a look, and I'm going to stay with Peabody right here and finish it up. You won't see them again for quite a while. But the chart action is just so pretty, and it's working on the Bollinger Bands that I want to show it again. The trend is certainly up with higher lows, higher highs. It is just beautifully put together here. Very neat. The market fought a battle at the 18-day average went up, hit the Bollinger Bands, and each time it pulled back. And as the market pulled back, it stayed into an uptrend, making higher lows along the way. We then got to the point where the market got overbought and we're finally getting a correction. So as I look at the trend, it is still to the upside. The independents, the big boys, those are still the spots making money, more so, by the way, than the crude futures are doing, or if you go into like oil, OIL, those particular areas. Support the 2570 zone right here. In KBE, you've turned the trend back down. So now what has happened with the bank index? Lower highs, lower lows. You've opened the door for the 200-day average right through here to the lower Bollinger Band, and momentum's turning down. I think the pros will be selling this short with stops over the most recent, well, the 2 weeks ago's high, which right here, I think I can get to it. It's right there at 49.83. They'd want to stop over that, and they're looking for the market, I think, to come down into that zone. When we come with the XLI, an event happened that I don't like. What had happened is the market slipped back this week. You had an outside week up. You took out the low of that week, which often leads to the market going to the closest moving average, which is insignificant as it's 98.13. But you're losing momentum to the upside in an area where the market's not embedded. Do I like when new traders come in, new being you? It could be not somebody new to the market, new to buy the market. Do I like when they come into this market in the 80s when you're not embedded? The answer is no. When I look at the energy sector here, where you can see we've come down, You lost the embedded reading. When you lost the reading, we should go back here too. I think we can come back another, there we go. You had an embedded reading last week. You lost it this week and you went right down to the objective, the 18-week average. It doesn't have to go any lower, but if it does, what will happen is the pros will have stops over last week's high. That high, let's see if I can get back to that right here. It's 92.25. They might be selling the market in this region. It's a $10 risk. I don't like that on an $80 stock. I think that's too much money to put at risk in a market. And they'll probably look for the market to go down to the Bollinger Band. In FXE, Freeport, well, everything still looks good. You know, the reports coming out all week about China's growth for next year. They're saying that their attitude on COVID has changed dramatically. They're throwing money at the economy for the property market, and we're hearing the word 5% growth for next year. Well, that'll certainly benefit the copper market. On the other hand, if you read the port data, which I do, the port data is showing a big buildup of stocks of copper. That means it's not being used just yet. So what's going to happen may also in the near term be a problem. The good news is many countries are talking to Freeport about long-term contracts. I think that's highly, highly important. I'm still the person that thinks that copper next year will be in the high fours. So, and that might be the second part of the year. I don't know what to expect on the first part as we hear about all this recession talk. I will tell you one thing I've learned in my career. When everybody's one-sided talking this recession, it's coming, you often don't get it. I don't know what else to say, but it's like you read all these surveys at the beginning of the year. Here's what's going to happen for 2023. Sure. If they knew that was going to happen, it'd be so easy. Go out on a beach, you know what's going to happen, you're done, you come back next year, you do another one, you adjusted your portfolio along the way. Most of that stuff is wrong. You have trouble going 30 days at a time, and you want to tell me what you're going to do for a year at a time? I'm not in that camp. When I take a look at the resistance in gold, it's very clear to me. It's between the 100-week average and the upper Bollinger Band. Now, we have those two big reports coming out. How is the dollar going to do? Because this market has come alive as the dollar weakened. Will those reports, CPI and the FOMC, weaken or strengthen this market? That's going to be the question, and that's what will drive the market. I think these are going to be difficult 3 days to trade, Monday, Tuesday, and Wednesday, and then the door opens. Of course, how long does it stay open? Because the week after, we'll all be getting ready for the Christmas vacation. And then I can't wait for the beginning of the new year because it's all behind us. And then I have a clean palette to work with and not the holidays. If you keep going, the gold miner should have resistance at the 100, the 200-week average, and the upper band. You're in the resistance. You're not in an area that's embedded. I'd be very cautious. If the dollar gets a pop here off these two reports, and that the word is if, I don't know if it will or won't, everything here is quite vulnerable for a pullback in the market going into thinner volumes at year end. In ARC, she just hasn't been able to get out of her way, all right? But people don't care. You know, what I've learned with Cathie Woods, she keeps getting all this publicity. Her performance is a disaster, but she's a thematic, famous ETF. That's the thing. It's the theme. It's that they're going to be at the cutting edge of revolution, technology that changes, whatever she's doing. Okay, but you can't tell me it was a good investment. It's got to be one of the worst investments of the year. In Apple, we are still looking at a pattern of lower highs, lower lows. I'm arguing that if the market continues in the downtrend, 131 is the level. I'm seeing people lift up banks upon banks, now talking again that their guidance calls for back to the 200. I don't know. I'm looking at that chart. I could be very wrong. You got to close back over the 18-week average to get me thinking that way. But right now, I'm thinking down, not up. Tesla, lots of calls over the weekend for Elon Musk to stop this nonsense with Twitter and start supporting the stock here. Lots of calls for stock buyback. They've got the cash, got a good business, and they're saying, let's support the stock and drive the value back up. Will he listen to that pressure? Will the board listen to that pressure? I don't know. What I do know as a chartist is if the market continues to break 163.18 is the 200-week average, that should be major support all the way down to the lower Bollinger Band, but I think it'll be the 200 that the market finally says enough's enough, we're down there. You have an embedded reading. Lose the embedded reading with the close over 21, and then you want to jump on board possibly saying, the worst is over and Tesla's going back up for a bit. Until then, no. And you know my thought about Tesla. At the end of the day, this is an automobile. And in all fairness, as much as you people all love Tesla, I'm a car freak. It is not a pretty car. I don't care what you want to tell me. It's basically a utilitarian world automobile. World. I can't wait to see what Caddies, Lincolns, all the fancy people coming out with really the custom cars that none of them have been releasing yet. I mean, you can't get your hand on these cars. My guess is 2023 we will see it. Then I'll have something to compare with. The interior of the Lucid, I know friends that have bought it. They don't like the interior. They go, it's not as comfortable as their Teslas were. They have had both, okay, but they like the car a lot. Okay. I haven't seen in Rivian one truck yet from Amazon on Chicago streets. I told you, as soon as I see one, I'm going to stop the driver. I'll wait, stop the driver, and have a talk with him about what he sees, what he doesn't like. I'm a car enthusiast, not a truck enthusiast, but I think Rivian's an interesting story. I like their niche. In Meta, okay, it certainly acts like the worst is over in this company. You've had a nice bounce. This bounce is still a bear market bounce because while you have higher lows, higher highs, you're under what I call the filter, the 18-week average. You lost the embedded reading. When you do so, and you did it back here, this market said you can't be short anymore. That's how I view it. This is the week it did it, November 25th. This says price and the 18-week average should make a run at each other. And that's what I teach in my charting course, and that's exactly where you're at. TLT, in looking at how this market is doing, higher lows, higher highs, but this BND, EFA, why do I want to be involved going into all these reports coming out? That's the news that we have. So I don't want to be involved. I want to sit back. I want to trade light for the next, starting Monday, Tuesday minimum. After Wednesday's FOMC meeting, my eyes are going to open. I'm still looking for the potential for the Santa Claus rally that's too soon right now to hit. The more we drop now, the better the chance of getting that year-end rally. And I think you have to pay attention to these Bollinger Bands and when they lose all that. So in that vein, you might want to take the rest of the year, learn something about these Bollinger Bands. I think you'll love what we've put together here. Take a look at this. Welcome. I'm Ira Epstein, and I'm here to talk about my enhanced Bollinger Band course. Now, many of you have taken my regular charting course, and if not, you might think you know something about Bollinger Bands. As you know, Bollinger Bands are an algorithm designed to keep the market trading within it 95% of the time. And on a chart, it will offer on the top part resistance, on the bottom support, and the idea is the market will travel within them. We know that sometimes it latches onto that band, goes up or goes down. Well, how do you play with that? Can you pyramid the positions off that type of thinking? Well, I've applied all three of these into 13 different videos that teach you my concept of it. And from that concept, you're able to work with weekly charts and or daily charts. The 13 videos, each about 7 minutes long. The idea here is not to put you in school forever, but to teach. Now, if you haven't tried my complete futures research, I throw that in as well. Whether you've tried this or not, I think it's worth taking a look at. I think you're going to learn something from there. That research, by the way, covers twice daily market updates for you and access to what I call window envelope numbers, which I think are very important when looking at these Bollinger Bands. The next part is a trial to our charting software so you can make your charts look the same way that mine do. It's that simple. Where do you go with it and how do you get all this? It's simple. You go to our website, www.iraepstein.com. If you go to the word education, everything you need is answered there. You can also call my staff. They'll be happy to help you get set up. I'm Ira Epstein on the road to your education.